All right, so proceeding here, you just said that you would have presentation currency, but also you'd have the functional currency. Presentation currency is just your choice, the currency in which you prepare the financial statements. But as for functional currency, actually, you said it is the currency of the primary economic environment of an entity. And we usually consider the following factors to determine the functional currency, right? So we say that an entity maintains its day-to-day financial records in its functional currency, right? That's why you say functional currency, but presentation is just for preparing financial statements. And so an entity should consider the following primary factors when determining its functional currency. How do you know your functional currency? How do you know the appropriate functional currency of yours? Actually, this question once came in SBR. You know, in SBR, you have to know the principles, not just computations. So the first thing to consider, we usually say the currency that mainly influences sales prices for goods and services. Now, let me just give you a hint. If you need to study this, just take a look at the financial statements. For example, if you start with the income statement, you usually have sales revenue, right? As the first line item. Is that right? So
Yes.
if that's the situation, that's why you find out the currency that mainly influences the sales prices of goods and services. And then if the second say the currency of the country whose competitive forces and this is not this is just a continuance and regulations mainly determine the sales prices of goods and services. Again, the same point has been repeated, but we are just saying that competitive whose currency of the country which the competitive forces decide that. Suppose maybe you're in Nigeria and there is your competitor in Ghana, and let's say maybe the currency of Ghana is weaker compared to yours. You know, if you have a competitor, the currency of whom actually is weaker than yours, it would be very difficult for you because they could sell at a price that you deem actually very cheap, but they could see it as just a high value, right? So that's why we say if someone is your competitor, it's very bad if actually the currency is actually of a lower value compared to yours. Actually, you could just check the currency of that competitor, and then that one should be your functional currency, right? So that you can compete well. And then we have the third point, the currency that mainly influences labor, materials, and other costs of providing goods or services. You should get this one well too. How do you get this one? If you take a look at this one could be like cost of sales. You know, for a manufacturing company, cost of sales equals to opening inventory plus production minus closing inventory. And what about production? Even if you have gone through performance management, you would know that when you're producing, you would have materials and then you would have conversion costs that are labor as well as overheads. So that's why when they speak of labor, materials, and other costs, it means like we are just speaking of cost of sales, although you cannot see it directly. So you have to see it that way. And then now we say here, if the primary factors are inconclusive, then the following secondary factors should also be considered, right? You should consider the following factors as the primary factor. Let's say you have checked at the primary factors, some favor one currency and some the other currency. That means you won't have made a conclusion. So consider the following. The currency in which the funds from the financing activities are generated. Just take a look, maybe the guys who are financing, who maybe they come from US, and so you could consider that one to be US dollars to be the functional currency, that there will be no need to convert them again. Maybe the currency in which the receipts from operating activities are retained. You may be selling goods and maybe you receive them in US dollars, but you actually convert them directly to the actually Nigerian nairas. And so that currency of Nigerian naira should be the functional currency. All right, and then that's how we determine that currency. Now, there are times when if a foreign subsidiary, rather than applying the above rules, should simply use the same functional currency as its parent. Now you're just speaking of the consolidation of the group accounts here. You are the parent and you have a subsidiary. Instead of a subsidiary actually following the above procedures, it has maybe to just to follow its parent depending on the following situation. Simply speaking, if it is heavy, it heavily depends on that parent. That's why we say in determining this, S21 said that the following factors should be considered. The first one, whether the foreign operation operates as an extension of the or the parent rather than having a significant autonomy. Lack of significant autonomy just means you are just an extension, you're just like a branch. So actually you just have to follow what the parent does, regardless of the country you are in, regardless of the factors above. But also maybe the level of transactions with the parent. Presume that maybe why the parent is in Nigeria, the subsidiary is in the US, but actually 90% of the transactions are made with the Nigerian parent company. That means that even those currencies, there is no need to convert them. You just have to retain them in Nigerian naira, right? And so if the level of transaction is very high, the subsidiary can just consider the currency of the parent to be the functional currency. But also, we say whether cash flows are readily available for remittance to its parents. Just presume it this way. The subsidiary is in the US, and maybe it is allowed in full actually to remit those funds which it generates each year back to Nigeria to the parent. If it's that way, that means it's just like it can just use the currency of the parent, right? And maybe the last point says that whether the foreign operation has sufficient cash flows to service its debt without needing funds from its parent. Kind of, it does not actually depend on the current to be a going concern, right? It can just pay it. It can just pay the debts by its own without requiring funds from the parent. That means it's kind of detached. So if it's kind of detached, it can use its currency maybe in the US. But if actually it really depends on the parent to pay off the debts, actually it would have to follow the currency of the parent, right? So that should be the situation here. And now we come to individual company translation of transactions. Okay, now let me start.